Listen, I want you to picture something. A Friday afternoon in January of 2026. A kitchen table in a brick ranch house in Knoxville, Tennessee. His name is David. He is 61 years old. He spent 29 years as a plant operations manager for a regional food manufacturing company. He was laid off 14 months ago when the company consolidated 2 facilities and eliminated his position. He has a traditional IRA with $490,000 in it. He has a joint savings account with $44,000. He has a small taxable brokerage account at Edward Jones with $88,000. His wife Linda is 59. She works part-time as a dental hygienist, earning approximately $34,000 per year. The household has been running on Linda's income, David's severance, and modest IRA withdrawals for over a year. David turned 62 in March. He has been researching Social Security online for 6 weeks. He found the Social Security Administration's online calculator. He entered his earnings history. The calculator showed him 3 numbers. At 62, his monthly benefit is $1,847. At 67, his full retirement age, it is $2,642. At 70, it is $3,276. David looked at those numbers for a long time. He thought about the $1,847 per month he is not receiving right now. He thought about the 14 months of living on Linda's income and his IRA. He thought about the $44,000 in savings that has been shrinking. He thought about the $1,847 multiplied by the 60 months between now and his full retirement age. The total estimated benefit over 5 years is $110,820. He thought about having that money in his pocket over the next 5 years instead of watching the savings account drain. He decided he is going to file at 62. He called his sister in Atlanta, who told him that was a terrible idea and that he should wait. He asked her why. She said she had heard that. He called his financial planner, the one at Edward Jones who manages the brokerage account. The planner said the break-even is around 78 or 79, and if David doesn't expect to live that long, the early filing makes sense. The planner did not mention the earnings test. The planner did not mention the permanent reduction to Linda's future spousal benefit. The planner did not mention the provisional income interaction that will begin the moment the first check arrives. The planner did not mention that the 30% permanent reduction in David's benefit is not just a reduction in David's income. It is a permanent tax on every financial decision David makes for the rest of his life, because the reduced benefit is the number that enters the provisional income formula every single year, at a level that keeps David below the optimal threshold management range for the next 25 years. The planner gave David the break-even calculation. The break-even calculation is not wrong, it is incomplete. It is the single variable analysis that dominates every online article, every retirement planning forum, and every calculator the SSA publishes. And it is missing the 4 tax interactions that transform the early claiming decision from a personal income question into a permanent portfolio structure consequence. That compounds against David's financial picture for the remainder of his retirement. That is what we are covering today. 4 specific tax mechanisms that the early Social Security claim triggers or locks in permanently. We are going to model each one in real dollars at David's income level. We are going to show what the 30% reduction in benefit does to the provisional income calculation, the IRMAA bracket structure, the earnings test while still working, and the survivor benefit that Linda will depend on if David dies first. And then we are going to walk through the decision framework that actually answers the claiming age question correctly by modeling all 4 interactions simultaneously rather than isolating the break-even calculation. Smash the like button right now. The Social Security Administration has a financial incentive to show you the benefit amounts and the break-even calculation and nothing else. Every year of early claiming is a year of reduced lifetime benefit that the SSA does not have to pay. Every like on this video breaks the suppression and puts this analysis in front of one more 61-year-old who is looking at the online calculator and making a decision based on one number when there are 4 numbers that matter. Hit it, subscribe, flip the bell. The Suits and Legal want me to say this is not financial advice. Fine, this is not financial advice. This is a forensic examination of how the early Social Security claiming decision interacts with 4 specific provisions of the Internal Revenue Code and the Social Security Act in ways that compound over a 25-year retirement. Consult a fee-only fiduciary who models all 4 interactions before advising on the claiming age. What I can do is show you the math. It is the permanent reset of the number that enters every tax calculation, every threshold comparison, and every spousal and survivor benefit formula for the rest of his life. What I can do is show you the math. Let me start with the permanent reduction mechanism. Because the 30% reduction in David's benefit at 62 relative to his full retirement age benefit is not just a lower monthly check, it is the permanent reset of the number that enters every tax calculation, every threshold comparison, and every spousal and survivor benefit formula for the rest of his life. David's primary insurance amount, the benefit he would receive at his full retirement age of 67, is $2,642 per month. At 62, the reduction is 30% for claiming exactly 60 months before full retirement age. His reduced benefit is $1,847 per month. The difference is $795 per month, $9,540 per year. That $795 per month is not recovered. It is not restored at 67. It is not adjusted when David reaches full retirement age. The 30% reduction is permanent, and it applies to every cost of living adjustment that compounds the benefit in future years. If the benefit grows at 2.5% annually through COLAs over 20 years, David's age 62 benefit grows to approximately $3,014 per month by age 82. His age 67 benefit would have grown to approximately $4,313 per month by age 82. The $1,299 per month gap at age 82 is larger in absolute terms than the original $795 per month gap at age 62. The permanent reduction compounds. It does not shrink. Now let me show you the 4 tax mechanisms that amplify the cost of the permanent reduction beyond the break-even calculation. Tax Mechanism 1. The provisional income interaction under Internal Revenue Code, Section 86. David's benefit at 62 is $1,847 per month, $22,164 per year. Half of that, $11,082, enters the provisional income formula under Section 86 in every year he receives the benefit. His full retirement age benefit of $2,642 would generate $15,852 in provisional income contribution. His maximum delay benefit of $3,276 would generate $19,656. The lower the benefit David claims, the lower his annual provisional income contribution from Social Security. This sounds like an advantage. In some narrow situations it is, but here is the interaction that flips the analysis. David has a $490,000 traditional IRA that is going to generate required minimum distributions beginning at age 73. Those RMDs will be significant. At 73, if the account has grown to approximately $620,000, the RMD is approximately $23,396. That $23,396 in RMD income plus the $11,082 provisional income contribution from the reduced Social Security benefit gives David a provisional income of $34,478 before any other income sources. The married filing jointly upper threshold for 85% Social Security inclusion is $44,000. David is $9,522 below the upper threshold. He has $9,522 of available headroom in the provisional income stack before the phantom multiplier kicks in at full force. Now Linda receives $34,000 per year in income from the dental hygienist position. Even part of Linda's income enters the household's combined income picture and pushes the provisional income closer to the threshold. By the time interest income from the savings account, dividends from the brokerage account, and Linda's income are combined with the RMD and the Social Security provisional income contribution, the household crosses the $44,000 threshold in most realistic scenarios. At the full retirement age benefit of $2,642, David's provisional income contribution is $15,852. The combined provisional income from all sources is higher. He crosses the threshold sooner and by a larger margin. This sounds like a disadvantage of claiming later, but here is the reversal. The provisional income that crosses the threshold generates the phantom multiplier on every dollar above $44,000. The phantom multiplier taxes $1.85 of income for every $1.00 of income above the threshold at the stated bracket rate. A higher Social Security benefit crosses the threshold but generates less IRA distribution income needed to supplement the benefit because the benefit itself is higher. The IRA distribution that is avoided by having a higher Social Security benefit is a dollar that does not enter the provisional income formula and does not trigger the phantom multiplier on the IRA distribution side. The interaction between the Social Security benefit level and the IRA distribution requirement is the variable that the online break-even calculator completely omits. A higher Social Security benefit reduces the IRA withdrawal needed to fund retirement, which reduces the provisional income from IRA distributions, which may actually reduce the total provisional income and the phantom multiplier cost relative to a lower Social Security benefit that requires larger IRA distributions to compensate. The direction of this interaction depends on the specific numbers and the specific household income profile. The point is that it is an interaction that must be modeled, not assumed. David's planner did not model it. David cannot model it from the SSA website. Tax Mechanism 2. The Earnings Test under the Social Security Act, Section 203. David is 61 and recently laid off. He is actively looking for work. The severance is running out. He may return to work in the next 6 to 12 months if the right opportunity presents itself. If David claims Social Security at 62 and returns to work before his full retirement age of 67, the earnings test applies. In 2026, the earnings test threshold is approximately $22,320 per year. For every $2 David earns above that threshold, Social Security withholds $1 of benefits. If David finds a job paying $60,000 per year, his excess earnings are $60,000 minus $22,320, equaling $37,680. The withholding is half of that, $18,840 per year. David's annual Social Security benefit of $22,164 is effectively reduced to $3,324 per year by the earnings test withholding. He would receive approximately $277 per month of actual cash benefit, despite filing at 62 and taking the 30% permanent reduction. The withheld benefits are not lost permanently. The SSA adjusts the benefit upward at full retirement age to credit the months during which benefits were withheld. But the adjustment is calculated as if David had simply not claimed for those months, not as if he had delayed. The credit restores some of the withheld amount but does not fully compensate for the permanent reduction that was already locked in at the 62 filing. The earnings test creates a specific trap for the recently unemployed person who files at 62 to cover income during the unemployment gap and then returns to work at a salary above the threshold. The filing at 62 locked in the permanent 30% reduction. The return to work triggers the earnings test withholding. The combination produces the worst of both outcomes: a permanently reduced benefit and an effective elimination of that reduced benefit during the working years when the earnings test applies. Tax Mechanism 3. The IRMAA Medicare Premium Surcharge Interaction. David turns 65 in 2029. He enrolls in Medicare. His 2026 income, which includes Social Security benefits, IRA distributions, Linda's income, and other sources, is the income that determines his 2028 Medicare Part B and Part D premiums through the 2-year lookback. In 2026, David is not yet on Social Security. His income is Linda's $34,000 plus modest IRA distributions of approximately $24,000. Combined household income, approximately $58,000. IRMAA standard threshold for married filing jointly in 2026 is approximately $212,000. David is well below the IRMAA threshold. His 2028 Medicare premium is the standard rate. Now in 2027, David files for Social Security. His full retirement age benefit of $2,642 begins. His provisional income increases. His household income from all sources climbs. In years when the RMDs are large and Linda is still working, the combined household income may approach IRMAA territory. The early claiming decision affects the IRMAA interaction in the following way. A lower Social Security benefit requires larger IRA distributions to fund the same lifestyle. Larger IRA distributions increase MAGI. Higher MAGI pushes closer to or across IRMAA thresholds. The threshold crossing triggers Medicare premium surcharges of $1,776 to over $12,000 per couple per year, depending on the tier crossed. The early claiming decision that was framed as generating more total income over 5 years may be generating larger IRA distributions that push the household into IRMAA territory during the Medicare years, adding recurring annual costs that the break-even calculation never accounted for. Tax Mechanism 4, the survivor benefit impact on Linda. This is the mechanism with the largest potential dollar consequence, and the one most consistently omitted from claiming age conversations. David is 2 years older than Linda. Statistically, women live approximately 5 to 7 years longer than men at comparable ages. The probability that Linda outlives David by 10 or more years is meaningful. When David dies, Linda receives the larger of her own Social Security benefit, or David's survivor benefit. Linda's own benefit, based on her part-time dental hygienist income, is minimal. Her own record may generate a benefit of $900 to $1,100 per month at full retirement age. The survivor benefit from David's record is 100% of what David was receiving at the time of his death. If David claimed at 62 at $1,847 per month, Linda's survivor benefit is $1,847 per month. If David had claimed at 67 at $2,642 per month, Linda's survivor benefit is $2,642 per month. If David had claimed at 70 at $3,276 per month, Linda's survivor benefit is $3,276 per month. The difference between the 62 survivor benefit and the 70 survivor benefit is $1,429 per month, $17,148 per year. If Linda lives 20 years after David's death, the cumulative difference in her survivor income is $342,960. David's claiming age decision determines Linda's income for the 20 years she may spend as a widow. The online break-even calculator models David's lifetime income. It does not model Linda's lifetime income. It does not model the combined household lifetime income across both spouses' survival periods. It gives David one number based on one variable and calls it a claiming analysis. It is not a claiming analysis. It is a single variable approximation of one component of a multivariable decision that affects two people across potentially 4 decades of combined retirement. Tell me in the comments right now. Tell me your age, your projected Social Security benefit at 62, 67, and 70, and your current household income situation. Tell me whether you or your spouse has a significantly lower earnings history that would make the survivor benefit calculation asymmetric. Tell me your state. Drop it in the comments. I read every single one. We model the 4-mechanism interaction together. Now let me give you the decision framework that answers the claiming age question correctly by modeling all 4 mechanisms. Step 1. Model the provisional income interaction in the first year Social Security starts at each claiming age. Calculate the projected IRA distribution needed to fund household expenses at each claiming age, given the benefit level available. A higher benefit reduces the required IRA distribution. Calculate the provisional income at each claiming age as the sum of the IRA distribution plus half the Social Security benefit plus any other income. Identify which claiming age keeps the provisional income closest to, but below the $44,000 married filing jointly upper threshold, without requiring excess IRA distributions that generate the phantom multiplier. Step 2. Evaluate the earnings test risk. Honestly assess the probability that David returns to work before full retirement age. If the probability is meaningful, early claiming carries the earnings test withholding risk that compounds against the permanent reduction. A realistic work probability of 40% or higher is a strong indicator that claiming before full retirement age is a trap rather than an opportunity. Step 3. Model the IRMAA interaction across the Medicare years. Project the household modified adjusted gross income in the years between Medicare enrollment at 65 and the peak RMD years around age 75 to 80. Identify the IRMAA threshold that the household is closest to under each claiming age scenario. The claiming age that keeps the household below the threshold with the smallest required margin of safety in IRA distribution management is the claiming age that minimizes the IRMAA exposure over the Medicare years. Step 4. Calculate the survivor benefit outcome for the lower earning spouse under each claiming age scenario. Multiply the monthly survivor benefit difference between the earliest and latest claiming options by 12. Multiply that annual difference by the lower earning spouse's projected survival years after the higher earning spouse's death. That product is the cumulative dollar value of the survivor benefit difference. Compare it to the cumulative dollar value of the early claiming benefit received by the higher earning spouse between the earliest and latest claiming ages. If the survivor benefit difference exceeds the early claiming income advantage, the later claiming age produces a better combined household outcome. Step 5. Add all four mechanisms together into a combined household lifetime income model that includes the direct benefit difference, the provisional income interaction cost, the IRMAA exposure, and the survivor benefit outcome. That combined model is the claiming analysis, not the break-even. The combined household lifetime income model across both spouses' full survival periods is the number that answers the claiming age question correctly. Now let me give you the geographic dimension because the state tax interaction with Social Security and IRA distributions varies significantly and changes the relative advantage of different claiming ages. In Tennessee, where David lives, there is no state income tax on ordinary income or Social Security benefits. Tennessee eliminated its Hall income tax on investment income in 2021 and has no general income tax. The provisional income interaction and the IRMAA interaction carry only the federal layer. The IRA distributions David takes to supplement a lower Social Security benefit are taxed at federal rates only. The combined tax cost of the early claiming decision in Tennessee is lower in absolute dollar terms than in high income tax states, because the state does not add a layer to every interaction. In California, the state income tax reaches 9.3% at David's income level. California taxes Social Security benefits proportionally to the federal inclusion. A California early claimer who takes larger IRA distributions to compensate for the reduced benefit pays 9.3% California state income tax on those additional distributions, plus the federal rate, plus the phantom multiplier cascade on the Social Security portion. The California early claiming penalty is substantially more expensive than the Tennessee equivalent because every dollar of additional IRA distribution needed to compensate for the lower benefit carries a 9.3% state premium. In New York, the state income tax on ordinary income reaches 6.85% at income levels comparable to David's situation. New York does exempt a portion of pension and retirement income for taxpayers over $59.5 up to $20,000 per year, but IRA distributions above that threshold are fully taxable at state rates. The New York early claimer faces the same amplification of the IRA distribution cost through state income tax as the California claimer, though at a lower rate. In Florida, no state income tax applies. The Florida early claimer faces the federal provisional income interaction and the IRMAA mechanism without a state layer, similar to Tennessee. The four-mechanism analysis in Florida and Tennessee produces the lowest combined tax cost of the early claiming decision because the absence of state income tax reduces the amplification of every interaction that requires larger IRA distributions to compensate for the lower Social Security benefit. Save this video right now. Hit the save icon. Add it to the Retirement Survival playlist, because the claiming age decision is not a Friday afternoon exercise with a Social Security Administration calculator. It is a four-mechanism tax interaction that determines the effective marginal rate on every IRA distribution, the Medicare premium for every year of enrollment, and the income of the surviving spouse for potentially 20 years after the higher earner dies. David is going to file at 62 in March if the conversation he has with his financial planner between now and then does not include the four-mechanism model. The planner gave him the break-even. The break-even is 78.5. David is healthy. He thinks he will live past 78.5. He probably will. The break-even analysis says delay. The four-mechanism model may say something different depending on the earnings test probability, the provisional income management opportunity, the IRMAA exposure, and Linda's survivor benefit calculation across her projected longevity. The four-mechanism model is the analysis, not the break-even. Subscribe if you have not. Flip the bell. Comment with your projected benefit at 62, 67, and 70. Tell me your household's income situation. Tell me your state. Tell me whether you have ever had a fee-only fiduciary model all four mechanisms simultaneously. We build the framework together in the comment section. I read every single one. The 30% permanent reduction is not a claiming option. It is a permanent tax penalty embedded in every check David receives for the rest of his life, amplified by the provisional income interaction, compounded by the IRMAA mechanism, and extended through the survivor benefit into Linda's retirement after David is gone. Running that penalty through a SSA calculator and getting one break-even number is not a plan. It is an approximation of one dimension of a four-dimensional decision. Model all four. Make the decision with the complete picture, because the complete picture may confirm that 62 is the right answer for David's specific situation. Or it may show that 65 or 67 or 70 produces a better combined household outcome across both spouses' lifetimes. The only way to know is to run the four-mechanism model, not the break-even, the four mechanisms. Run them before March. I will see you in the next one. Stay strategic, stay furious. The early claim trap was built for the retiree who saw one number on one calculator and made a 25-year decision. See all four numbers. Make the decision with the full model.